Okay, welcome everybody. Tonight we've got the pleasure again of having Gordon Scott and Joseph Anderson doing a presentation for us. These are fellows that are highly skilled in training people how to invest. And the reason we're pleased to have them with us is because a lot of people ask me, well, what's wrong with your training? And I always go back to a story about when I was in high school and I had to take algebra, and I'm decently good at math. And when I went through my algebra course, surprisingly enough, I got a D-, which obviously if I wanted to head off to college, that wasn't good enough. And I just wasn't getting it. So I took it in summer school with a different teacher, and the way he presented it just made everything crystal clear. I mean, I could understand it perfectly. So with that, tonight, Gordon is going to be showing us, his topic is going to be the trade you can't afford to miss, which gives you a different perspective on how to look at technical analysis, plus using candlesticks, and why a different viewpoint just makes you more alert as to what's happening. Then he's going to Joseph will follow up, kind of giving a little bit more description of the coaching. So with that, Gordon, good to have you here. We're anxious to see what you've got for us tonight.
Thanks very much, Stephen. Very happy to be here. Honored to have the opportunity to speak with all of you this evening. As part of Stephen's coaching team, I want to say that Joseph and I are really excited to share with you this information because, you know, the markets have been in kind of a whipsaw, back and forth, sideways. You know, it's slowly moving up, but it's been very difficult for some people to find success in their trading. And I know that periods like this are frustrating. It sort of shakes your confidence. And, you know, when we're talking to our coaching students, some of them would say, well, you know, I tried this and it didn't work, and, you know, went up a little and then just came right back down. And what do I do? What am I missing? How can I get, you know, better trades? And really, this kind of a market is an exercise in patience. You've got to learn to look for that trade that you can't afford to miss. Not the trade you aren't quite sure about, but, you know, the trade you can't afford to miss. Well, I'm going to give you some ideas about that, and it's important to recognize that the times like now where the market kind of goes sideways and this sort of upward wedge that we're moving into, that's often an indicator for a big bearish move. Not a really huge one necessarily, but, you know, we could see as much as a 5 or maybe even 7% correction here between now and the end of the month of June. But the market's just not acting like it wants to do that. It's acting like it wants to push higher and remain bullish. So, you know, a trade situation like this means that there might be a really big move. People often, when they lose their confidence, they kind of pull back. They say, no, I don't want to keep losing, so I'm just going to sit back until I see something happen. And the problem with that is this idea. Well, you see, what happens is that if you look over the past several years, the reality is that just a few days missed in the market can have devastating effects. If you were to buy $10,000 for the stock on January 1st, 1980, and just hold on to it till year-end 2012, it'll be even more now, year-end 2014, because markets have gone up higher even since then. But if you just held on to it, reinvested all the dividends, that sort of stuff, $332,000, 500. I mean, that's kind of, you know, you hear numbers like this, and you think, wow, stocks are the way to go. Well, hey, everybody knows in between now and then we had a couple of really, really bad bear markets, which actually, if you know how to step aside and you're a candlestick forum trader, you'd know that you can do even better. But the main point is that if there's that much value in stocks over time, does it matter if, you miss out on some of the bigger trades along the way? What if you just happen to miss one here or there? Well, missing the best 5 days has a profoundly negative impact on your overall results. I mean, even so, those results are still pretty good, but look at this: missing 5, missing 10, missing 30, missing 50. So if you're sitting out of the markets, you might not be there when the big move comes. And that alone is a rather motivating idea. Where do big winners occur? Well, the answer, surprisingly, is they can come from anywhere. I'm going to use some Dow Jones stocks to exemplify this. I don't mean to suggest that the best place is to go look for the best moving stocks in the Dow. In fact, right now, probably NASDAQ and small cap stocks are a better opportunity. But I'm just going to use Dow stocks because, hey, if these look good, then you can bet that other, higher growth stocks would look even better. So if we just compare the Dow from 1994 up until now, last 20 years, the top stock, out of 30 stocks, the number one stock on average has gone up 70%. And the worst, the stock that's done the worst out of the 30 stocks of the Dow, and this is on an annual basis, right, has gone down negative 24%. So you look at this and you say, yeah, well, you never know. It's a roll of the dice. You're up, you're down, whatever. Except look at those numbers. The worst we go down on average is minus 24, and the best, I mean, the average on the upside is more than double that. So it's kind of interesting, isn't it? I mean, you look, take a quick scan across the top lines. You see there are a number of stocks that have all doubled in price, and the number of stocks that have dropped by more than half on the underside is only 3. So it's, the basic idea here is the winners outpace the losers. And that's a simple but realistic idea. If you're investing, if you're staying in the game, the winners outpace the losers. Over the long run, especially when the market's in a general upward trend, which, for as choppy as we are still in an upward trend right now, it's better. It's better to stay in the game. And that's just one of the reasons why the stock market's worth looking at. I mean, what's your alternative nowadays? Bonds? There's hardly any interest there. Gold? It's going nowhere. Oil? Pretty volatile. So, I mean, stocks, that's really kind of the best game in town for the past few years, and likely to remain so. The average annual increase for the top 5 Dow stocks each year. See, if you just think, well, that top winner, that's an outlier. That's just going to be, well, okay, have a look at the top 5. The average is 44%. That's still bigger than the worst stock of the Dow, which worst stock should be an outlier, right? You go to the bottom 5, they're going to be even less. So the point I'm trying to make here by showing you all these little numbers is you got to keep your head. You got to maintain your confidence. There are good trades out there, especially when the market is running to the upside. Now, it helps to kind of have a game plan in place. That's what we like to do as Stephen's coaches is work with Stephen's students to help them recognize, hey, be prepared. Be ready. When you see certain candle setups, that's great. But when you see certain candle setups that occur during periods of time or seasons during the year where you're going to have a greater likelihood that something's going to happen, well, that's a powerful punch. That's a pop. And you want to be ready for that. So look at this chart, and it's going to give you the idea that the biggest moves that we're going to have this year haven't happened yet. Now, we've had some reasonably good up moves, nothing compared to last year, but if you look at the Dow Jones average over the last 111 years and you just average out what happens, mathematically, an average of how the stocks move throughout the year, this is what you come up with. This chart is what they call a seasonal pattern, and this seasonal pattern shows the average of the activity. So during the first 5 months, we get this chug, 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 but then June through August, zip, up we go. Big correction coming into the fourth quarter, and then another zip at the end. So the big moves usually come later in the year. Now, it's not always that way, and it certainly every year doesn't look exactly like this. This is an average, so they all sort of look different. But do you get an idea that the trends are quite possibly the strongest through this time? I mean, if you're going to have an uptrend based on these averages, where's it likely to fall? That's right. Amazingly, in the summer months. See, this May goes up, chops down. You can get an idea where people have, make that saying, sell in May and go away. But, look what happens after that. If May is a dip, then it's only logical that at the bottom of that dip, you've got a relatively good place to be trying to make a move. So your next trade could be the big win of 2015. Now, I'm not suggesting that I know the future and that, hey, run out and buy any old thing because it's all going to go up right from here. I'm saying that statistically, well, it could be a loser. It could also be a winner, and winners over time tend to be bigger than losers. So this isn't a bearish year. Don't lose your head. You need to stay ready to look for opportunities. And you can't get the best winning trade if you aren't trading at all. So it means you got to get in the game. You got to participate. But hey, if I make a trade and it's not the perfect trade, I'll lose. I'll lose money. Isn't that bad? Well, actually, as long as you're controlling your losses, playing the game in such a way that if you're wrong, yeah, you're not going to lose more than 1% of your account or so, then you're better set to catch those winners because you're in place, right? You can control the losses if you're careful, and that's what we like to do as coaches. We like to make sure people are given the tools. We have custom spreadsheets, custom trading plans set up for your own personality, and that's how we do it. We say, all right, what are we going to need to do to control your losses if you're wrong? Such that if you're right, you really take off. So here's another thing. 2015, not just any year, but 2015 could end up being a really great year. So this is the U.S. pre-election years. This is just a sort of pattern for how the pre-election years look ever since 1960 to now. And this is kind of an interesting little pattern. Start off slow, they really get going, and then through this stretch here, April through July, then they sort of taper off, and then they pop again at the end. Now, pre-election year, this has to do with the presidential cycle, right? 4 years. The year where the election occurs is the actual election year. In this case, 2016. The year after is the post-election year. The next year is the mid-election year, and the third year, if you were coming off 2012, that would be now. 2015 is the pre-election year. So the year before an actual election occurs, same thing. This is an average of all of them over the last 50 years. A little more than 50 years. Yeah, 50 years. Anyway, so it's going up, and it's a strong year. In fact, of the 4 years, it's the best one. It's the best one. It's up over 20% on average some years, and this, since the last 40, it's up 14%. That's just an average, right? So look what happens. When it goes up, pre-election years, you get a big move that goes from 2 to 12, basically a 10% move. Have we seen a 10% move yet? Not even close. Not even close. And so the majority of this move, if it were to come, I mean, for all we know, it could even be bigger. But if it were to come, it is a little late in coming, and it could really move strong, and it could be a big. So I mean, we could see an incredible, rocket launch of a summer. Wow, I mean, that would really be a big move. Now, that would be a surprise to me. The market's really sleepy, but that's just it. Big moves come from surprise, sleepy markets. So it's just an important thing to be aware that if we are going to have a big upward move, you'd have to watch for signs of what? Well, breakouts, stuff that's breaking out of resistance, right? That had been going sideways for a while and all of a sudden just decided to break out. Okay, well, let's see. What are likely to be big winners? Where could you get an idea? Where are those big winners going to come from? All right, so here's an idea. You can follow the rotating business cycle. This is something that happens. You get, when you have a recession, then the first movers into the recession are financial companies, because all of a sudden, once the recession's over, then money is, interest rates are low, people like to borrow, and so they go to banks, and so financial companies, banks, they start doing more business, and they make loans. And what do people do with that money? Well, they spend to become more efficient. Often they'll do technology and discretionary spends for appliances and or if companies, then big factory purchases, that sort of thing. So they have to ramp up new machines, new factories, new methods, new services to take advantage of this low cost money and the fact that, okay, we kind of hit bottom, now we expect consumers to begin spending, right? So that's what happens next. And then as that works, assuming it does, if that works, then these companies say, great, we've got all our factories built. Now we need to make more products. We need to buy more basic materials, and we need to ship that product. That's going to, we got to run our machines. That's energy. We got to ship them. Transportation, that's energy again. Basic materials and energy are the next phase. And then once everything gets really expensive, because, price of gas goes up, price of transportation, price of oil, all commodities all get expensive, then people kind of back off on their spending, and then investors move over to the stuff that they have to spend their money on, toothbrush, Tylenol, whatever, right? Consumer staples and healthcare, that's the next thing that tends to follow. And then as the market begins to, as the economy begins to kind of shrink a little bit, people run for safety, and they go to the utilities sector for that, and it rotates all over again. Now sometimes, even within these bigger cycles, you get rapid rotations right through this, just inside of 3 or 4 months, for whatever reason. It's just people, it's investors trying to sort of throw stuff against the wall and say, well, let's see if this will stick. Are we moving from one to the other right now? And so they'll try it. So you get these little mini rotations. And if they follow, great. But where we are right now is really kind of interesting. You would think that we should be kind of up at the top with energy, high prices, right? But in fact, the way the market's acting right now, last year we had a pretty strong utility movement, and the utilities have kind of backed off, and guess what's happening? Financial sector is moving into it. Now, how do you track this stuff? Well, you just look at the sector ETFs, the XL stocks, right? XLF, XLK, all these. And right now, financial sector is kind of moving pretty good. So then you pick one of them, any one of them that happens to be doing well, and you look at the top 10 stocks inside that sector. So if the financial sector is looking good, here's a list of some of the stocks that round out the top 10. I mean, they're household names: Wells Fargo, JP Morgan, Bank of America, Citi, Goldman Sachs, AIG, US Bank, American Express, household names, right? Then you go check in those charts, and see which one of these is doing even better than XLF, because that means it's performing above average, has momentum. So that is just a simple way to get down and find out what stocks are likely candidates to pick whatever sector has done well in the past 3 months. That's one that's likely to continue doing well for another 3 months. And in the case of the financial sector stocks, you can look specifically at Goldman Sachs, J.P. Morgan, Wells Fargo, and Bank of America. Like I say, these are big headliner stocks. There's another chart that I didn't show you here, but if you take that seasonal thing and look at all the sectors, the financial sector tends to do better in the last half of the year than in the first half of the year. This over as many years as this is trackable. But that's kind of an interesting thing. You think, okay, well, if we're going to have a little bit of doldrums and then all of a sudden we're going to race out of them, we're going to have a good year, if in fact we're going to do that, where are the likely candidates? Well, financial sector. It's already starting to show signs of doing well, in part because people are expecting interest rates to go up, in part because, hey, have you noticed the housing market is just hot, hot, hot. It is a seller's market right now, don't you think? I mean, you've probably noticed this in your own neighborhoods. If you look around, houses don't stay on the market very long. If you look at the coasts, California, New York, I mean, these are markets which are top dollar. They say that supply, that is how many houses are actually available for sale in San Francisco, is so thin right now that prices are just jumping astronomically. Well, okay, that's an interesting thing, but what does that have to do with stocks? Well, it's an important thing because if people are still finding the money to push into these higher and higher prices, that means banks are making loans. And the reason interest rates are going up is not because everybody's worried about the Fed. I mean, that might come too, but it's simply because there's more demand for loans. And if there's more demand for loans, guess what industry is going to be making money from that to be successful? Banks, financial sector. See? So that's kind of an important thing to think about. Well, we talked about the trade that you can't afford to miss. I'm going to show you a stock in just a moment. And I don't want you to get the wrong idea. I don't want you to think that I'm making a buy recommendation that's like, oh, you must buy this because you can't afford it. It's a stock like any other stock. Nobody knows the future. We don't know what's going up. But it does have a number of characteristics that are a really nice setup, and I want to just show these to you as an example so that you know what to go looking for. And this is the kind of thing we do with a coach. You come and you talk to a coach and you say, well, I mean, everything I'm doing here just isn't working. Okay, can you give me any ideas? Well, sure. I got an idea. I got an idea that looks like this. If you want your trading plan to be filled with stocks like this, here's how you'd find them. And here's how you'd trade them. So I'm going to show you this stock. And it's not a straight up guaranteed recommendation, but it's not a bad idea either. So give it your own open-minded consideration, but more important, learn from what I'm going to show this to you. All right, so the stock that I'm referring to is the Bank of Hawaii, BOH. Now, if you think real estate in New York and California is expensive, just think about how expensive real estate is in Hawaii. Cost of living in Hawaii is very high, and yet people still go there to live. When you have a bank that services, I mean, I'm sure all sorts of banks are working in Hawaii, but specifically a bank that is, Bank of Hawaii, right? They just reported not too long ago in April, and what they said, among other things, was that the quality of credit is better than it has been in the past. So, quality of credit, right? People buying and, well, maybe they don't really have the income, and price got pushed so high that, you know, people had to sort of fudge some numbers and stated loans, blah, 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 2007 housing market bubble. Yeah, no. That's not where we are right now. Where we are is that between 2013 and 2014, credit got better. The quality of the loan the Bank of Hawaii is making is better, and they earned more money than analysts expected them to earn. So what's happened as a result of that is this most recent surge of the past month has you know, gone up, and we're hitting a new multi-year high. For about a year, I didn't put that much of the chart on here. I wanted you to be able to see this. For about a year, it was in kind of a sideways mode, and then right through here, it broke out of it, and so it's kind of come back and retested this $60 area, and now it's off to the races. Price target, the lowest price target that anybody has on this is at least $65. Some had a target up in the 90s. It might be a little aggressive, but you know, it's a company, a bank, that is benefiting from this hot housing market. And as long as the housing market remains strong, as long as demand remains strong, well, you can bet that a bank like this is going to be at the forefront of capturing that. So those are that's sort of the backstory behind it. But then you want to look at a couple of technical things. So first off, big dip, right? You love to think, oh, I want to be able to sort of gap thing right here, sort of, you know, we gapped up to this doji, gapped down to the doji, gapped back up. Right in there is this emotional window area. And notice that that is the long-term support that is kind of held right there at 58, 58 and a half range. So that's held. So now what we're looking for is the breakout right up here at about 62 and a half. Could it be that that's what we've just experienced? And in fact, this actually was captured earlier in the week, so it has continued higher since then. And notice that we've got the breakout, we've got a little bit of support at 62, and coming up, say, hey, look, if this is 62, we've got this bullish engulfing kind of candle here. I mean, this is a really strong bullish signal. We got the, you know, moving average crossover a few days back. I mean, just it's got everything going for it technically. Does that mean it's a guaranteed win? No. It means you need a plan. So I mean, it's got a lot of the right stuff, but what's the plan? Well, see, in other words, if you were to have bought here or here, somewhere in there, you'd have to have a plan that would allow you to stay in it all the way through all of this, or take profit, take profit, take profit, right? I mean, you can pick and choose whether you want to hang on to it and hold for a year, or you want to try and capture something in the space of 2 weeks to 4 weeks, or you know, 2 weeks to 2 months, or even shorter, 2 to 5 days. And again, that comes down to the kind of plan you want. So if you wanted to do a 2 to 5 day plan, then this sort of activity right here, this little gap up and go, that puts the you know, buying price right there at about $63, and your stop loss right around here at 61 and a half or 61.70, and you've only got what, $1.25 per share risk there, with the possibility of heading on up to $65, right? More potential upside than downside. Simple thing like that gives you the plan. Now, you don't know where it's going to go, but what you do know is that you have a plan. And when you have a plan and you consistently carry it out, maybe you lose on one, maybe two, maybe three, but one of them wins. And when it does, and it pays out well, and it keeps going in this strong trending market, in this, you know, if it's going up, it's probably because all of a sudden the market kicked into gear. And so when you do that, all of a sudden you get this big winner that pays for a lot of little, you know, learning experiences, right? That's the nature of this game. And if you try to tell yourself, no, I'm going to win every single trade, well, you're not really understanding how the game's played. But if you play the game well, as we looked it over, it's a very profitable game. See, now, the deal is right now is a great time to get prepared. When you have these choppy sideways markets, it's hard and it's frustrating. You think, I can't do this. No. That's a call for education. That's a call for learning. That's a call for, hey, get prepared now so that you're doing the right things already before the breakout comes. Because if you're doing them and they're in place when you break out, bingo. And, you know, that is the great thing about trading is that, well, it's the kind of thing that you can learn whether the markets are open or closed, and the dividends that it pays. I mean, you can do it from anywhere, right? But I got to tell you, not everybody wants to trade, whether it's trade for a living or, you know, just sort of help their IRA or, you know, improve their 401k accounts in whatever fashion they can. Not everyone is able to do so. What I found is that the ones who do, they say the difference between success and failure was having a solid plan to follow. Now, individuals prone to emotion, that is emotional reaction. Hey, everybody has emotions. The question is, do you feel the need to react over that emotion, right? That's the differentiator. People that say, oh yeah, I'm worried about trading, but I got a plan. I'm sticking with my plan. So I'm not letting my emotion change my action, right? Well, you might not think of that as discipline, but it is. It's emotional control. People who have emotional control do better. And you make your money when you prepare, because then your emotional control is already set. If you have to try to discipline yourself while you're trading, right? That's like trying to tell yourself that you're not going to eat when you've gone 24 hours without food and you're standing right in front of an all-you-can-eat buffet. Oh no, I am not going to eat. I'm just not, right? Hey, it's hard. It's hard to do that. Why play that game? It's a lot easier to prepare ahead of time, to keep yourself well prepared mentally and numerically. So you know, hey, these are the odds I'm working with. These are the strategies I'm using. Well, that's entirely the realm that we work in when we try to coach with Stephen and his students the things that we do. See, let me just wrap up here and give you these ideas to remember. Big winners are more profitable than big losers, and big winners do happen. 2015 may yet feature several big winners, and you need to be prepared with the trading plan before the opportunity arrives. Before, not as, because you won't recognize it unless you're prepared before. Well, I want to say, let me turn the time over to Stephen now, tell you about the value of coaching. Stephen, when you're ready.
Okay. Yes, and the next person we're going to be listening to is Joseph. Gordon, thank you very much. One of the main reasons people keep asking, well, why do you have other coaching people coming on if you're the candlestick teacher? And the answer to that is I teach candlesticks. I teach it in a manner which is the way I have become successful at it. But the way I teach it may not be the correct, or not the correct way, but the most understandable way for most people to learn. And I kind of use the illustration that you could be a professional baseball pitcher with a coach, and you've got your fastball and your curveball down pat, but you're just not a successful pitcher just yet. Even though you've gone through it time and time again with your coach, then another coach comes in and says, all right, well, if you add this, or if you look at it or do this a little different way, now what you already have now may fit into your mindset or into your physical skills as far as a baseball player. Then all of a sudden it starts kicking in. So, and people like Gordon know how to teach people. His background of investing over 20 years includes 10 years of training people how to invest successfully. And prior to that, he was a market maker on the NASDAQ. So you have to definitely know what's going on as far as investment sentiment when you're right there on the floor. So with that, I'm going to bring on Joseph. Joseph, I'll let you go into a little bit more of what kind of the different aspects that we can help people with.
Great. Thank you, Stephen, and thank you, Gordon. Good evening, everyone. My name again is Joseph Anderson. I'm the Program Director for the Candlestick Forum Coaching Department. And you've just heard from one of our coaches, Gordon Scott, and I've been asked just to take a few minutes here and briefly explain the opportunity of working with a coach. And in doing that, I'm going to outline the 6 commitments that we make to every student that participates in the program, and then I'll hand the time back over to Stephen when I'm done here, and I'll just kind of get right to the point. A lot of you listening, if you have additional questions, or if once I get to the end of this brief explanation of the program, if you're interested in getting more information, I'll go ahead and explain the next step at that point. So I'm just going to quickly go over these 6 commitments. So the first commitment that we make to every student that we work with in coaching is to clearly identify your goals and objectives. So the first thing your coach is going to do is quickly assess where you are now versus where you want to go. You would be amazed at how many investors we work with from all over the world that do not have a clear goal or objective in mind other than just to make money in the markets. But your coach cannot lead you until they understand what it is that you want to accomplish. Now, once we understand your goals and objectives, then you'll be ready for a customized plan to be created for you. And we will understand your financial reality now versus what you want it to be. In essence, we will see the world through your eyes, then gradually expand your vision to a much larger picture than you can see right now, so that you see the potential we see when you look at the markets. Okay, so the first commitment is to clearly identify goals and objectives. The second commitment becomes the development and implementation of a strategic trading plan. I'll tell you guys now, this is probably the biggest differentiation, or what differentiates those that consistently succeed in the markets and those that consistently struggle. You know, Gordon brought up a really good point about emotions, and we all have them, right? But learning to detach yourself emotionally from the markets is easier said than done. Here's the thing, you're going to have bad trades. You're going to have bad days. You're going to have a bad week. And you've got to almost be okay with that, right? The one you want to avoid is a bad year. That's the one you don't want. And the way that you avoid that is by being consistent in your approach to the markets. And the only way you can really become consistent is if you have a system that you consistently follow, right? If you've got that, if you do not have that system, well, then how are you basing your decisions? Well, you base them off the way you feel. Well, since the way you feel fluctuates, your decisions fluctuate, right? And if your decisions fluctuate, I'm telling you now, you'll never see consistency in the markets as you go through the approach. You really want to get to the point where you learn to treat your wins and your losses the same, right? So many of us who are emotionally trading, we have a loss, and that loss forces us into a state of desperation, right? Now we're making desperate trades trying to make back that loss. Or we go to the other extreme. Some of us do really well for a period of time, and as a result of that, we now become overly confident. Well, one extreme is just as bad as the other. You want to get to a point where you have a loss, you shake it off, you move on. You have a win, you accept it, you move on. But you move on the same, right? And that's all about having this system and this plan. And so that second commitment is to identify and develop a strategic plan that's customized to you. And I'll talk about that a little bit more here in just a minute. The third commitment, number 3, is expert enough to coach others. Okay? So expert enough to coach others. Now, we're not talking about you becoming a coach for us, but rather your own level of proficiency will be such that you could literally coach someone to succeed the same way we would have done with you. Whether that's a family member or a friend, we believe one of the best measurements of what someone has learned is their ability to share that knowledge with others. I'm sure that makes sense. Number 4, okay, fourth commitment, positive results, making money. Now, we know that your interest is in doing, not just learning about doing. So many of us spend so much of our lives in a state of getting ready, to get ready, to get ready, and never really focus on the most important part. That's the execution, the doing, taking action, right? So the fourth commitment is simply to teach you what the most successful traders are doing and then to actually do it with you. And as you create a strategic plan and follow those rules, you will start to see the types of gains on a consistent basis that will get you to your financial goals, which is obviously what you had in mind to begin with. Okay. Number 5, the fifth commitment, customization of the entire learning process to you. So during this powerful learning experience, your coach will customize every lesson to your level. So for those of you listening that are beginners, we'll move at a pace compatible to beginners. For those of you that are intermediate traders now, we'll move at an intermediate pace, or for those of you trading at a mastery level, which usually means you're doing this full time, then we would customize coaching to that level. This is not a cookie cutter approach where one size fits all, and we understand that. Okay. Now there's a little asterisk down there, the trader's resource line. Basically what this is unlimited access you have to Gordon and our other 5 coaches. We have a total of 6 coaches. To Gordon and the team of coaches Monday through Friday from 10 a.m. to 10 p.m. So anytime you have a question, anytime you've placed a trade or you're a little hesitant to pull the trigger, you can pick up the phone, get a coach on the line and have them go through that trade with you. And as I've been conducting interviews for the coaching program, I've been working with Steve for some time now, I've received a lot of feedback on my exposure to the program. I will tell you that this is probably one of the greatest values that a lot of students get from it. Think of the last time you placed a trade and you lost money and the difference it would have been had you had the opportunity to pick up the phone, get a coach or get Gordon on the line and have them go through that trade with you. Okay, for a lot of us, it's night and day difference. And then we'll go ahead and move on to the 6th commitment here just for sake of time. Number 6 is cementing the correct habits. Okay, your coach will instill or cement the necessary habits for you to become the investor you're saying you want to be. Now, part of cementing the proper habits is fixing any bad habits you might have incurred over the years. You see, habits are the key to consistent success in the markets. We know that. That's why it's important that we make sure that you have a plan or a system in place and that you really learn to follow that system. Okay? So these are the 6 commitments that we make to every student that becomes a part of the coaching program. Now, I went through these very, very quickly. Okay, I can imagine a lot of you have probably additional questions in regards to what's involved and other questions you have about the program. I will make something, I think, clear up front. This is not a program for those of us that are just looking to dabble in the markets or perhaps do this as a hobby. This is a program that's specifically targeted to those that are looking to do this as a supplement or mainstream of income. So if you're at a point where you're looking to do this at that level, perhaps you want to do this full-time, perhaps you want to transition out of your work and replace your income, that's what this program is focused on, right, is developing the correct trading habits or behaviors that get you to that level of trading. Now, for those of you that are interested in getting more information, okay, you're going to notice a poll appear on your screen, okay? So a poll is going to come up. That poll is going to have 3 different options, okay? The first option, yes, please contact me. Option 2, not at this time. Again, the biggest challenge for a lot of students, before I hand the time back over to Stephen, the biggest challenge that a lot of students struggle with is not so much a lack of knowledge or a lack of information. A lot of you listening have invested in books and manuals and DVDs and workshops, and the information that you get is very valuable, but the gap that people experience is, again, not a lack of knowledge, but more a lack of understanding on how to use that knowledge they already have, right? Knowledge is just a tool, and that tool, like any tool, is only as good as your understanding on how to use it. And the focus of this program is not so much to load you up with more information, but rather to guide you and offer direction on how to use the information that you most likely already have. Now, of course, we fill in the gaps if you're missing information, but the focus this is a results-based program. It's application-based. as you go through that. So with that being said, I look forward to connecting with those of you that either selected yes or maybe. One of our customer service team members will be contacting you here in the next day or so. We'll go through a brief conversation and then see if there's a potential fit with what you need versus what we offer. For those of you that are viewing this as a recording, of course, you're not going to notice a poll appear on the screen. You'll notice a URL link at the end of the webinar. Just go ahead and type that in for more information on the coaching. With that being said, I'll go ahead and hand the time back over to Stephen. Stephen, when you're ready.
Thank you, Joseph. Yeah, everybody, the reason we're doing this kind of, I want to say, more comprehensive training is that, I mean, I tell people to observe the obvious when it comes to investing. And part of that observe the obvious is, more than likely, you have never had or most people have never had the opportunity to get more education on how to invest, mainly because you don't get it from college, you don't get it from high school. If somebody was training you how to invest, that means they would be investing well themselves and may not be spending the time with you. Gordon and Joseph are people that have been training people how to invest, and not just to say, all right, here's, again, I've got my method of training people, which is more, here's the information and here's how you interpret it. Whereas they're coming back from the other direction, saying, you've got the information, now how are you interpreting it, and how can we help massage your whole process so that you're comprehending what you're doing versus just following what maybe the charts are telling you. And so it's more to kind of dig a little bit deeper and give training to people. Again, the reason I wrote the third book, How to Control Your Emotions, is because even though you may have the best investment program in the world, if you don't know how to implement it, not so much mechanically, but say with your emotions out of the trade system, you're going to just be plodding along like I did for years until I really hunkered down and as Gordon was saying, or Joseph was saying, you have to have your program and your strategy, and it's got to be something that you've developed in your own mind to follow. So with that, we're going to be concentrating more on teaching people how to invest, again, mostly from an educational / emotional aspect of investing. And then from my part, we're going to go a little bit deeper into each of the candlestick signals and patterns so that you learn how to use them. So you're going to get kind of a double whammy here. Is not only are you going to get more information on how to assess mentally and visually when a good trade is setting up, but then you'll have people like Gordon or Joseph saying, all right, now here's how you mentally get prepared for being in these type of trades. So with that, we'll cut it off early tonight. But yeah, if you're serious about investing, and you don't want to be just kind of plodding along, get with Gordon, get with Joseph. I think you'll find it's going to be very valuable for you. So with that, Gordon, Joseph, thank you for being here tonight, and thank you, everybody. We'll see you all in the chat rooms.